I went long gold.
So we take like this low, we take like the blow off top, maybe come back into the halfway point and then reconnect with like a trend line support.
But I'm saying that the Fed has a track record of not always being able to pull it off.
That is an undefeated sign of recession. One thing that has kept this market going way more than the Fed is fiscal policy, not monetary policy, but fiscal policy.
There's one beautiful thing about gold, and that is Chris, last week was crazy. I mean, at the end of the day, we had, the market loves it. The market's up 0.5% again today. And, I'm kind of just, maybe I'm just capitulating here, but I think that jobs data was really what the market wanted to see. It wasn't awful jobs data, but it was the first. I added this little chart to the Edge Finder I've been showing off today on stream. It's just taking the actual number minus the forecast and just create a dot or a bar chart for us. Okay. So we had 5 months consecutive of beats or higher than expected jobs data. And what I loved about this chart is that we did have something similar in November. You had the first kind of miss in November, but look at the magnitude. 63,000 is a much bigger difference than the 30,000 miss that we had in November. That being said, it's one data point, so I think we have to be a little careful we get overly bullish. But is this what the Fed and the stock market wanted to see, Chris?
Well, what I kept seeing after the fact, so after Friday and over the weekend, was the Goldilocks job numbers that the market wanted to see, because Powell on Wednesday was pretty much saying that stagflation is not going to happen. We're going to be data dependent. I mean, he talked brilliantly out of both sides of his mouth on Wednesday. I was backstage with you guys just listening to the press conference. Which I usually don't listen to him, but it was fine just to take in, what the market's going to try to digest. And on top of that, it's like he always does a great job of giving the market just a little bit of what they want, but never enough to run with it. And so I think the jobs number on Friday was something the market liked to see, because we have had this talk of a hotter job market, hotter labor market, tight labor market, and finally it started to show a little bit of slack. And then also, the Fed is essentially, it's not guaranteed, but they're likely not raising rates, right? That was the early threat this year and I'm still a little flabbergasted that we go from 6 to 7 rate cuts expected into this year. And now the market's like, if you guys want to cut 0 times or 1 time, it's okay. We can still get to these all-time highs. We can maybe still hang around these all-time highs. And the market, outside of maybe the April sell-off, has showed, again, a lot of resiliency. So I think the market liked what it saw on Friday with the slack in the labor market. I think the market was digesting the Fed like it always does. The Fed is going to be setting everything up in June. If we go to the let's go to the CME watch group again.
I beat you to it, Chris. I got it pulled up for you.
Go ahead and show it then. I just want to take a look at it. Yeah. Any major shifts? I mean, right now September is. Okay, so now it's shifted again, where the expectation is that we will have a cut coming in September. Yep. July is still anticipated pause at 67%. So September is now nearly at 50% that the market's expecting a cut in September, and a pause still through November and December. So that's the market.
Check this out, Chris. I've got the probabilities chart here. I got the probabilities chart pulled up too.
Yep.
Very interesting. So as you're mentioning, you got September looks to be where the market's saying, probably our first cut.
Yep.
And then you're seeing really, a pretty solid chance that we do see it by November. But then also look at this. There's a second rate cut.
I saw that for December. Yeah. Yep.
Yeah. So we're very interesting to see that. And then, a third rate cut going into 2025. So, but again, as you just mentioned, Chris, this thing has been moving wildly. I mean, it has gone from 6 rate cuts down to 0, now up to 2. I mean, we have just seen this thing become violent. And it makes me kind of always just think, the idea that the market is just completely efficient. It just goes out the window when you look at stuff, in my opinion, when you look at this stuff and you say, look, this, the Fed can't predict what's going to go on. How is the, if they've got everything and they can't predict it, then how is, anybody supposed to be perfect about it? How's the market supposed to be perfect? But yeah, anyways.
Did you know that we have 100% free trading tools and data available for you on our website, a1trading.com right now? We have free courses for you to browse. You can also check out things like retail sentiment and free articles from our analyst Frank that include things like Edgefinder screenshots and trade setups. You can find all of this and so much more for free right now on our website, a1trading.com.
I think, Chris, what I went long on Friday was I bought gold, which is a little bit contrarian to the cheering that's going on in the stock market. I do still have positions on the stock market. I've got VOO and I've got a covered call going on with that. XLK with a covered call on that. I sold calls on Friday. I've got some plays in the stock side, but I went long gold because all things aside, the Fed doesn't always get it right. As you mentioned, this cooling in the jobs market data, there is a chance that it's not just healthy cooling, that perhaps some of the signs of a slowing economy are real too. What do you think? Well, like gold.
I was going to say that was going to be my next point was, we're going to have another round of inflation data for the month of May. That'll be April's inflation data. I mean, Powell seemed pretty confident that inflation data is going to go down, and stagflation is not a concern. But the one thing I think is a very interesting indicator is anytime that we've seen a 1% increase in a rolling 12-month period for unemployment, recession happens much tighter than the window than the inverted yield curve, right? The inverted yield curve, the 2 and the 10, the 3 month and the 10-year, those inverted yield curve can go on average of like 2 years before we actually hit the recession. That's like, oh yeah, the inverted yield curve called it. That's the track record. If you have contraction in residential construction and you have contraction in the job market with unemployment rate going up by 1% in a rolling 12-month period, that is an undefeated sign of recession. So the number that we need to see is 4.4. If we hit 4.4%, that's that 1% shift, because the lowest we had was like 3.4 in May or June of last year to now. So I think you're right. Like, that could be something that in the background and underneath the hood, not a lot of people are paying attention to, because it's like they're so focused on, oh, finally the job market is like relaxing a little bit. But in that same breath, it could be, well, crap, is this actually getting worse? Like, is unemployment trickling higher?
Yeah.
So
it's gonna be really
like,
fragile. Be careful what you wish for. People who are cheering the idea of now, again, I'm not saying that number on Friday was a doom and gloom, this is the end kind of thing. It honestly was really what the market, as you mentioned, I did the same kind of research over the weekend too. It was pretty Goldilocks. It's hard to deny that the market is accepting and willing to say, hey, you know what, we need to see labor slow just a bit here in order to see that inflation come down meaningfully. The problem, Chris, is that the Fed doesn't get it right all the time. And so when you start to see the signs of slipping economic data, it's rare. It has happened. Like 1995 is a great example of where they successfully pulled off a soft landing. But the idea that just, a soft landing is guaranteed is dangerous, because that's what the market's priced for. The market is now priced very much for, we're not going to have any, major hiccups. This Fed is going to be able to pull it off. And I'm not saying that they cannot, but I'm saying that the Fed has a track record of not always, being able to pull it off. It's very hard stuff to predict. They don't know when interest rates are going to be exactly where. They also don't know exactly how the economy is going to reflect or react to their monetary policy either. So just got to be careful.
And one thing too, that, we spend a lot of time talking about the Fed because everyone's watching the Fed and it's in your face every single month.
Yes.
The one thing that has kept this market going way more than the Fed is fiscal policy, not monetary policy, but fiscal policy. That's the one thing that probably won't shift a lot in 2024.
Sure.
Fiscal policy is going to stay very elevated. And I think what we're noticing is how much influence fiscal policy, in addition to monetary policy, have. So right now we have a Fed that's shrinking balance sheets. arguably tightening since we've had one of the most aggressive rate hike cycles ever in the history of the Fed for the last couple of years. But yes, now the market's pricing a lot of stuff. We've had this crazy 5-month rally. I do think that, so here's my thoughts for this week. And I said this in my earlier session. We have 1,234 companies reporting earnings this week. We've already had the Mag 7s. We had the Teslas, which, went from 140 now to 180. Apple announced a record-breaking buyback program, so Apple got the market all excited last week. Amazon had good earnings. Google and Microsoft had good earnings. So we've had the Mag 4 mega caps, top 5 companies lift the market higher. I think this is a chance for the broader market to also show that it's not the S&P 5, it's the S&P 500, and see what else can actually land with positive forward guidance with decent earnings. Because if we don't get market breadth in earnings this week, then I feel like it can easily fade right back down to where we started. I still think technically I'd like to see if I go to we were talking about gold. I bought gold at 212. I bought GLD at 212 last week.
Oh, nice.
If we go to the SPY right here, I mean, we're trading at 514. We also have created 2 crazy large gaps from Thursday, Friday last week, even the gap open today, that, prices might stay somewhat elevated. If it fills the gap today, okay, cool, maybe it does. But again, if we just drift higher all week, or we drift higher with gaps all week, we test the highs, I don't see how we can go into summer trading with crazy bullishness. I don't technically see that. I was thinking that last week, the way this flushed down so aggressively, correction, that this week is going to be a really important week to see how bullish can we maintain this posture, because otherwise we're right back where we started, where it's like, oh boy, another flush lower, even though that would be very contradictory to what the market seemed to be excited about last week. So sure. I don't know. I mean, this week and the one thing we're noticing too, week to week, month to month, is the markets don't really have big days unless it's a major catalyst week. So this week's pretty light. We don't have a ton of major news this week that I saw. We have a couple rate decisions in the Forex land, Australia, and the pound. But CPI data is going to be next week, I believe. So your CPI, PPI lineup is going to be next week. And I think that's going to be the next round. That's potentially a catalyst to see where this market wants to go. And by that time, Nick, we might be at the all-time highs again. The SPY might be retesting 520, 525, and then CPI comes in stickier, and then the market doesn't like it, and we just have some chop going into, maybe end of May. And we know the saying, sell in May, go away, which, true or not, I mean, we can see if it just struggles to break these highs again until maybe there's another big catalyst coming, maybe October, November with the election. I don't know.
I think there's a good number of reasons that you could see just a period where we don't just resume back to the straight up move. I think the invincibility feeling that the market had going into 2020, end of 23 and into 24, I think that's cracked. I think that there will probably be more consolidation in the coming few months than in the previous. And that's not stating anything outrageous. This is just a incredibly outsized performance. So I'm not saying anything super hard or super impressive there. It's probably going to have more normalized returns going forward than it has in the last few months. Normalized returns means you get dips and you get pushes, and over the long span of time, you're up, 8% a year. So I think that, we've had a huge run already, but 8% per year. Here's another thing, Chris. I'd be curious, I'm sure somebody has this data. It's easy to grab, would be, in years that the market is up, what's the average performance? Not all years, right? So I think that the rest of the year for the stock market is likely to be up. I could be wrong about that, but we've had a really good start. I think most of the worries are behind us. The economy is overall strong. Jobs is pretty strong. The Fed seems to want to cut rates. It's an election year. I still lean bullish. And so I'm curious, in a positive year, what is the expected return? Because it's not 8% on a positive year. The average of a positive year might be like 20%. The overall, return is like 8% to 9%.
Right.
But I'm just curious, that maybe there's something there where we do see some consolidation, but if we expect a 20% plus year on a positive year, maybe there's room to look for buy the dip opportunities. And maybe, as you mentioned, you're looking to broaden out. I think if the stock market rally continues, you're probably right about that. If the market rallies, you probably don't continue to see this, just the tech doing great and everything else not doing well. And part of it, Chris, is too, the tech rally is hard to dispute. It's the only area that has massive earnings growth right now. Other areas are lagging, but if that changes, the catch-up trade can be pretty violent.
Yeah, well, speaking of, I mean, what's leading the way? It's like we're not being led by tech right now. I mean, I don't know if you looked at this, but this to me is nuts. And this is also another potential concern under the hood, is how are we being led by energy and utilities this year? Right? I mean, yes, we've got consumer services led by literally Google and Meta only. It's like 40% of the entire sector is those two companies. But energy at 10.41% year to date, and utilities coming back out of nowhere. I'm actually in my trading room today. We're going to take a look and deep dive into utilities. The downside with utilities is individual companies. I mean, if they're beat down, maybe, but it's like, that's not the needle that I want to play. I want to buy the haystack utilities, trade the sector, have it be more liquid, trade options around the sector. And I don't know. I feel like the diversification that the sectors are showing me right now, energy leading the sectors as a whole, usually is not a strong bull market. That's like, I mean, that's got signs of sticky inflation all over it. Utilities maybe are getting a little bit of the nod because of the AI infrastructure going on in the background, where all these purchases are being made to expand the grid, handle more energy consumption, and maybe that's why utilities get a big bump. But this was a terrible sector last year. In everything, I mean, it was just led by, your Mag 7 kind of S&P 10, if you will. But I don't know. So go back to your averages. We're already up from the start of the year, around, 8-9%. The average election year does average right around like 17 to 20%. I mean, historically, it balances to be about 11.85% for the election year. But in a bull market recovery, especially a move like this, like we had in October, November, a lot of times those moves can be, 20 to 30%. We've already had this low from October to the high that we saw. The all-time highs is like, I was going to say just over 28%. It's 28.3%. So we're there. I mean, does it just do the average, Nick? Is it just going to be like, it's 12% year? I mean, it's better than 8, but it struggles to really make any massive strides. I still think that the Dow could be able to hit 40,000 this year. It was just shy of that when we had the all-time highs before. Here's the Dow Jones right here. I mean, we came in with highs at 39.8. It's right there. So, I mean, do I think we hit 40K this year? Yes. But here's another thing. We can make all-time highs, right? We can make all-time highs again in the next month. We can make all-time highs again in the next 3 to 6 months. But what happens if this is the play? What happens if this is our sell-off? Okay. Let's say that this is sideways. Okay. Let's say that we go to all-time highs. What happens if this is the structure? What would you do if you saw the market do something like that? What would your thought be as a technical trader?
Well, so if we saw currently a little consolidation here for a little bit, I think that's fine. There's no threat to it. But if you do see, consolidation followed by a big breakout, okay, in that moment I'm feeling really good. I'm like, okay, we're looking very, very solid. But if then what you're saying is we come back and just consolidate in that same general area, that looks like possibly just a longer term head and shoulders kind of thing, where maybe there's again, it would depend heavily on what the fundamentals look at that time. This price action is one thing, but where are we at with the Fed's story? Are we beating inflation at that point and just consolidating now that a lot of our victories are behind us? Is that the scenario? Or is it back down because the inflation has ramped up again? And in that case, I'm looking at this very, very carefully, because we could very well see, that head and shoulders turn into a bigger correction. So I think it depends on the story for me. What about you?
Well, I mean, if we go to that larger, so you're on, well, you were just talking, that was gold chart you had up. But if we did that on like the SPX or SPY, I mean, if that's the trade that we had, let me go SPY, try to clean up my charts a little bit. All right, let's go to the daily chart here.
This artwork, Chris. You can't,
I know, right?
Clean up artwork.
it's funny because to me, it's like I see through all that stuff, but I know if somebody's looking at my charts for the first time, they're like, what is that? What's up with this dude's charts? All right. So here's where I think it would be a little alarming, right? If you go to a weekly time frame and we've gone, outside of this broadening pattern right here, where we had the correction, the COVID crash, we blew off that top, kind of the perfect measured move. And then we have this. If we form a topping pattern, I mean, my concern is that we come all the way back into that point. So we take like this low, we take like the blow off top, maybe come back into the halfway point, and then reconnect with like a trend line support, something along those lines where, I mean, we'd have to see where it stops. And to me, this is probably the most logical case is, let's say that we find a way to go higher. We put in a topping pattern, we consolidate, maybe one flush lower. I guess the ugly side would be if we did some major damage around this 4,000 level on the SPX. That would be really concerning. But I feel like if we just came back to a major trend line, had a double-digit correction, and then we'll see how accommodative the Fed really is, right?
Sure.
So I just think that I hope this is to be true, but normalizing monetary policy where we can't just go in boom and bust cycles, and anytime there's a crisis or anytime the market doesn't like it, and all of a sudden it's a temper tantrum and the Fed's like, we'll go to 0%. You're welcome.
Yep.
I mean, I don't think at this point, with what we've seen in the radical monetary policy the last couple of years, I don't think that the future is sustainable when it comes to boom and bust cycles. We raise rates to 5%, we cut rates down to single digits, or we cut rates down to less than 1%, and then we raise them back up again. It's like that. I mean, I guess it can happen, but it's like that amount of volatility that we would expect with bonds and equities, it would be chaos to have that be like every couple of years we're going from like, sub 1% interest rates to 5% interest rates. That'd be insane. But that would also show how almost incompetent the Fed is, because they really don't have a lot of tools, and it's they want price stability, they want labor numbers, they want monetary policy to work. But it's like, I'm telling you, fiscal policy, monetary policy, right now we have been juicing this market with fiscal policy, and if that is what dries up and changes, in addition to the Fed trying to be tight right now, I think that's where we maybe put in a deeper correction. But to this point, this doesn't mean I'm bearish. I mean, right now, this is a year that I was very bullish going into this year, very bullish on it's an election year. There's not a lot of disruption. This market will justify a lot of reasons to just keep blinders on, keep going forward, go higher, and then worry about it later. So I still think we're there. I mean, but here's what I am doing. Last week, I added a little bit. I added another 2% exposure to gold. I do have positions in Bitcoin. I am trading more energy now. I'm going to look at utility sector. So, I mean, I'm going to get a little bit of maybe 2 to 3% exposure in my portfolios for some alternatives, for some potential, I guess, hedging, but maybe just some non-correlated stuff where I can continue to trade the indexes and see if we just keep melting up higher. I mean, look, the broader market going up is not a bad thing. Every time I see the broader market up, I'm typically looking at green in my portfolio. It's not a bad thing. So that's what I'll keep, grinding on. But
and Chris, I just want to touch on the gold. You mentioned one of the reasons I think gold is up a good bit too. Here's the thing. Chris mentioned that he's looking for uncorrelated assets, and Chris is not alone in that. So is the Chinese,
right.
Central banks around the world. There's a lot of desire for, you really don't have, if you have $1 bajillion, that's not even a number, but if you have stocks and you have bonds and you have gold, you don't have that many options to diversify. Like, really, these two things in the last couple of years, they move together. So, there's one beautiful thing about gold, and that is it has low correlation. Look at the historical correlation. Gold has low historical correlation to this. So when people see the stock market trading at high multiples, and they see tech is just, where everybody is crowding into a trade, and they see in the last few years what can happen to the bond market is not immune to horrible crashes. The bond market, look at TLT, and tell anybody that there's no risk in bonds, and look at what happened here. There's a peak to trough. There's a 50% drawdown on what's supposed to be just a safe haven spot to park your money. And so you look at all this and you say, okay, you have stocks, bonds, and gold. Bonds have shown recently that they can be terrible. You know, the stock market is red hot, but maybe if you're not wanting to put all your eggs in one basket, as it's had such a crazy, you know, as you mentioned, fiscal policy run, gold starts to look really attractive. And also, I saw this thing, and this is where I can start to become my, you know, inner perma bull on gold. The price of gold may look expensive, but it's actually quite cheap, historically speaking, to its purchasing power over the centuries. You know, a century ago, you could go buy, I don't have the stats in front of me, but you could go buy a house for like X number of pieces of gold, like ounces of gold. Now you can buy a lot less house for that same amount of gold. The point is, over the very long term, gold has a track record of retaining its value. And so it may move a lot in the meantime, but I believe that there is a large catch-up trade that is due for gold. And whether that happens now or another period of time, you know, could be now or 5 years from now or whatever. I think over the long term, gold is going to catch up and retain its long-term purchasing power that it's held throughout human history. So, you know, there's an argument longer term. That's why I'm a perma bull on gold, generally speaking. I think it's undervalued despite where it's at. Sure, people freak out and say, oh my gosh, 2,400, but that's just a number on your screen. What's the value of gold if the stock market falls apart?
Right.
It's suddenly going to be 5,000, suddenly going to be way higher than where it currently sits. Is that fair? What do you think?
It's very fair. And again, I mean, we have no idea, but I think for most investors, savvy investors, funds, managers, whatever, I think it would be wise to have like a 3 to 5% exposure, because what we don't know is like, I mean, I would say that the gold move we've seen thus far has been somewhat. You can take the screen back on your side, Nick. I'm just going through a couple of trades right now.
Sure.
The gold side, I mean, I wouldn't call this move from, you know, the break above 2,000 to, you know, 2,200 on a quick sprint. I wouldn't call that parabolic. But I think what people don't understand is, let's say that gold turns into cocoa.
Yep. Yeah.
I mean, I'm just telling you, like, let's say that gold goes to 5,000, 6,000, 8,000, 10,000. What happens to that 3 to 5% exposure? That could be the reason that you save your entire portfolio because of the speculation run on it. But that little bit of exposure makes all the difference in the world. I mean, if you take, and by the way, did you see what cocoa did last week or the last couple of weeks? We went from like 11,000 spot to like 8.
Hold up this chart. Look at that crazy chart.
So it finally did what we saw. I mean, lumber was the big talk in 2020, and lumber was up, you know, same thing, parabolic, and then it crashed. I actually listened to a podcast this weekend, and I was curious, like, could I look at cocoa futures? Is it time to take a trip? I don't know. I feel like I'd be playing with fire if I wanted to jump into cocoa, but
I just don't know enough about it. I'd have to study it, to be honest, but it is a very interesting chart. Just a parabolic rise and then fall.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.